Welcome to Cambridge House. I'm your host, Leanna Haakons, and today I am pleased to be joined by Adrian Day. Adrian is the founder and CEO of Adrian Day Asset Management, an international speaker, contributor, and author. Welcome, Adrian.
Well, thank you for having me, Leanna.
Pleased to have you here, joined with us and our viewers and listeners today. I know that everybody that watches and listens to this show is likely an active investor or interested in investing and making returns. So tell me where in the world you are finding good value these days.
You know, there aren't very many places where there's good value. People talk about the bubble in everything. And so markets generally, not only have they had really good runs looking at price, but in terms of valuation, they're certainly not inexpensive on a historical basis. You look at the world market today, it's trading, world markets in general are trading at about 19 times earnings and yielding less than 2%. And that's all markets, including some of the very cheap ones. Developed markets are even more than that. Mm-hmm. So where am I finding value? Right now, relatively few places, frankly. The Hong Kong market is very, very inexpensive. Single-digit price earnings, less than book. It's down about 25% since the summer. And of course, we know why. There's concern about China and China's growing influence on Hong Kong. One of the things I learned early on, I wish I knew who said it, who told me, but it's very smart advice, which is if you feel very comfortable, completely comfortable buying something, you're probably not buying good value, because there's always something that's making those things inexpensive. So certainly Hong Kong is one. And frankly, in terms of markets, that's about the only market I think is cheap right now.
I am now investing in contemporary art. And why? Because the dozens of billionaires and multimillionaires that I've had on this show, they do it too. I'm just following the leader. Since the mid-90s, contemporary art prices and appreciation have actually outpaced the total return of the S&P 500 by 164%. I want a piece of that action. So the way I do it is through a platform called Masterworks. They allow me to buy fractional ownership in those classic names, the multi-million-dollar paintings by artists like Monet, Picasso, Andy Warhol, etc. If that painting is sold after I buy my ownership as a part owner, I get paid out on that sale. Or if I just want to liquidate my position prior to, I can do so on the Masterworks secondary market. Personally, I don't intend on that. I dollar cost average in. I intend to park cash there for the long term. If you're interested, check out masterworks.io and follow me down this path.
There are sectors that we like. And also, frankly, the other thing that I think is where you can find value right now is what I call opportunistic buys. So it might be a market, a sector, or an individual stock, but will fall on temporary factors. You think they're temporary, and they normally or often decline more than they should based on that factor. I'll just give an example, if I may. Fortuna Silver, they had a permit denied. This is 6 months ago now. Okay. And the stock lost in market value more than twice the value of that mine. So if they just wrote off the mine and walked away, the stock still declined more than it should. So you see opportunities like that, but they sort of come and go.
Mm-hmm. And that's that behavioral finance side, the emotions that go into investing and being able to ride out those waves as someone that's holding long when you do see something like that, or taking advantage of those opportunities when you see a sell-off that's unwarranted completely.
Right. I mean, you see a stock, it can be in any sector. They miss their guidance by a penny and the stock goes down 15%. I mean, it's frankly pathetic.
And it's flashed across all the headlines on all the networks. And
well, also algorithms, I think. You've got algorithms, and when they see earnings miss, the algorithm just kicks in and the stock falls.
Yeah, and that high frequency trading and all the new technology we have now in the markets kicks on. But hey, it's great for people like us that look for opportunities in investing. And as an asset manager, I'm sure that you're looking for those opportunities for your clients all the time.
Correct. Absolutely. Absolutely. And sometimes it's markets, as I say. I remember, again, this is 6 months ago, the British market fell because of something that we call Partygate. which was the prime minister doing naughty things during COVID when he was telling everybody else not to.
Right.
And, when you think about it, that shouldn't affect companies' earnings, companies' exports. It shouldn't really affect it. So at that time, we loaded up on a bunch of high-quality British companies that had just fallen because of a political scandal.
Excellent. Well, I'm glad that you're seeing these opportunities and taking advantage of them for your clients. I know that obviously you are an expert in resources. You are a big writer. You have your latest book out after being a financial writer for many years. Your latest book called Investing in Resources, How to Profit from the Outsized Potential and Avoid the Risks. Where are you seeing opportunities for returns specifically in resources right now, whether it's an area, a type of resource, or geographically?
Right. Well, in the immediate term, I think many of the resources, they all spiked because of a Russian invasion of Ukraine. And I think in the immediate term, some of these prices have moved ahead of where they should be. I mean, at worst, what we're seeing, and I'm talking purely investments here, at worst, what we're seeing with most of these resources is a supply chain issue. So the Russian mines are still producing nickel. They're still producing palladium. It's just that those resources, with sanctions from Western Europe and the US, those resources are in the wrong place at the wrong time. So that will get sorted out. And those Russian nickel will find a buyer. Might be in Africa, might be in the Middle East, definitely will be in China. And the nickel that China was buying from other, or iron ore, or whatever it is that they were buying from other suppliers, will then be displaced and will be available to the West, to the countries that aren't buying Russian resources. So I think in many cases, it's a supply chain issue, but will get sorted out, over the coming weeks and months. A little bit different for oil, I should just point out, in case someone says, well, what about oil? Because the problem with oil is Russia doesn't have any of the big Supermax tankers. They use very small tankers to transport from the Baltic Seas into Frankfurt, into Northern Europe. And if they have to sell that stuff to China, it has to come out of the Baltic, into the North Sea, all the way around the Suez Canal, all the way over to China. Not only does that take a long time at your cost, but they simply don't have the big ships. Mm-hmm. So that's a different issue. But so that's my immediate thought in looking at markets right now. But what I would be focusing on are the resources where not only do you have growing demand, but you also have fundamental supply crunches or supply tightness that has nothing to do with Russia. And an example of that would be copper. Copper prices almost doubled in the last 12 months before Russia. Nothing to do with Russia. Russia produces 10% of the world's copper, so it's a small factor. The price has almost doubled. But Richard Atkinson, the CEO of Freeport, the largest publicly traded copper company in the world, said the tightness in the market is far beyond a price issue. So the price can go up, but we're simply not getting more copper produced. Large copper mines are a very, very rare thing indeed. You can look at the list of the top 10 copper producers in the world and the top 10 copper mines by resource in the world, and half of them are over 100 years old. We find very, very few new large copper mines. And when we do find them, it can take 6-10 years to get them permitted and into production. Mm-hmm. So we can look at the copper market, and unless the demand collapses, we know that the prices are going up just because of the tightness in the supply.
Wow. And I'm going to ask you in just a couple minutes, I'm going to ask you maybe to pinpoint a little bit more some opportunities and maybe even some problems that are facing the mining companies right now. But before we get there, I want to stay on the Russia-Ukraine situation just for a moment. You're a portfolio manager at the Euro-Pacific Gold Fund. And as an expert in gold, how big of a driver would you say the Russian-Ukraine crisis is right now for gold, if any?
Yeah, well, you only have to look at a graph, really, of the last 6 months or a year to answer that question. You saw a huge spike the day after Russia invaded Ukraine. We've been up to 2050 in the US dollar terms, I'm talking now. Went up to 2050. And then since then, it's slowly come back to whatever it is today, 1930 or something. If you look at the trend since the Federal Reserve started planning the tightening at the end of January, we probably could drop another $50 or $60 to get back to that trend. Mm-hmm. But $50 or $60, frankly, on a $1,900 price is not extreme. So I guess what I'm saying is that there's most of the geopolitical premium has already evaporated. And geopolitical premiums tend to be very short-lived.
Right.
If you look at the history of them over the last 40 years, they tend to be very, very short-lived, and we're seeing that here. But there's still some premium, so it could come down a little bit more. But, frankly, I think it's going to be shallow and, even more important than that, short. Mm-hmm. The monetary factors, to me, are far more important. Again, we're not talking humanitarian, but the monetary factors are far more important for the gold price than the Russian invasion at the moment.
And so what types of trends are you looking at in the news or in progression in the situation in the Ukraine in terms of your own gold fund?
Well, obviously, and you see this in the market, you see this with the dollar, which is a safe haven currency, and you see it with gold. Anytime there's news about possible negotiations and one side or the other says, we've made some progress, gold drops. I mean, in my view, I think it's almost inevitable that whatever happens in Ukraine, gold will come back to that longer term trend. And so I don't want to get overly concerned on a day by day basis what's happening. When you're a gold fund, you frankly can't afford to day trade. Mm-hmm. Because of all the rules and regulations about how much you can buy of anything. You can't day trade. You have to look at longer term fundamentals.
Mm-hmm. And that does provide stability for your investors as well, I assume.
Well, absolutely. Absolutely. I mean, I like to focus, my whole approach is to look for what I think are the best quality companies with the best managements, strong balance sheets that are trading below where I think they should be trading at. We're not looking for companies that might have a good drill hole next week or anything like that. And good luck to people who do that. I'm not, there are people far smarter.
Whoever has that crystal ball, right?
Well, but there's people who are good geologists who have much better ideas about what may or may not happen. I tend to focus on people, balance sheets. And frankly, I like to hold good quality companies for a long period of time. And let them develop and play out their plan. Mm-hmm.
Well, as someone, it's actually Financial Literacy Month here in the US for me. Focusing on the long term is something that I try to encourage a lot of investors to do rather than making day in and day out trades and moves in their investment portfolios. And on that note, to end our chat today, maybe you can give us some more specific ideas of maybe some of the threats and then also opportunities within mining companies themselves, whether it be gold or another resource that you're seeing in the markets right now.
Yeah. Clearly, some of the base metals have a risk if the Chinese economy slows dramatically, because China buys 40 to 60% of the world supply of most commodities. So if their economy went into reverse, that would have a significant impact on things like iron ore, steel, copper, and so on. So that's one risk. I think the risk that is, but that's a maybe risk. The risk that is much more certain will be higher input costs. We've seen energy is the largest cost of running a mine, pretty much any kind of mine, not just gold mines. And we've seen the price of oil, go up 50% in the last 3 months or whatever, and double in the last year. So energy price is important. And then local costs, and the biggest factor for local costs is the value of the local currency against US dollars. And I say against US dollars because, of course, most commodities are sold in US dollar terms. At the moment they are. Maybe in a few years, when China does what it does, they won't be. But at the moment, you sell your gold in US dollars. So what's important is what are your costs in foreign currencies? And we've seen the foreign currencies, the Canadian currency, the real, Brazilian real, the Australian dollar, they're all beginning to move up. But and this can be a very significant thing, because if you look back to the early 2000s, 2004 to 2007, gold price doubled from about 450 to 850, and the margin of the gold producers stayed exactly the same. The margin stayed the same because the costs were going up even more than the price of the product, the price of the products that they were selling. We're not quite there at this point, because you look at copper, you look at oil at about $100 a barrel. Back in 2011, it was over 150. The Australian dollar at 70 or whatever, it was 110 back in 2011. So we're not there yet, and the margins are still very, very strong, but that is unquestionably one of the big risks. The other risk that is also an opportunity is the difficulty of finding new mines, and this applies to uranium, nickel, gold, silver. When's the last time you heard about a new primary silver mine being discovered?
Right.
So the difficulty of finding these mines is a problem for the industry, and it's a problem for the producers, but it's an opportunity for the smaller companies that have a small, good operating mine, or for the exploration companies that make a discovery, or frankly, exploration companies that simply have a lot of prospective ground. So that's a negative, but it's also an opportunity for us investors.
And just before I let you go, you have a lot of great information to share with investors and some of your clients and our listeners and watchers here. Could you let us know where we can find you and more information about some of the projects that you're working on? Or things you're looking at?
Thank you. It's It's Adrian Day Asset Management, no apostrophe S. Adrian Day Asset Management.com. That's
Perfect.
the website.
And you have some resources and some great stuff for people to look at there, I'm sure.
Thank you. Yes.
Wonderful. Thank you so much for joining me today, Adrian. Thanks for coming to Cambridge House.
Well, thank you, Leanna. Thank you for having me.